So this is the lesson 10, money management. So today we will talk about the how to calculate the risk and reward ratio, and how to set target profit and stop loss, and how to keep a proper recording of the transaction. So all these are part of the money management. And a lot of times, I believe you have heard so often that people always talk about the risk and reward ratio. Okay, and in fact, for traders, right, the risk and reward ratio they have to follow. But if you are like Warren Buffett style, the buy and hold kind of a strategy, right, maybe you do not need to because you are buy and hold, so you do not need to cut loss. So therefore, you do not need to looking so much about this risk and reward ratio. And risk is actually, the word risk is referring to cutting loss. So if your position is not for cutting loss, then you do not need to look at it. But if let's say you are planning to cut loss, right, then you need to calculate the risk to reward ratio. Okay, so let's look at it. So this is a table showing you about if you lose certain amount, certain percentage of your portfolio or your equity, okay, or of your portfolio lah, and then the amount of return necessary to restore to the original equity value. So for example, our if you look at the Dow Jones Industrial Average, the Dow Jones and the S&P 500, during the March, the COVID-19, the MCO, right, the index actually dropped by 35%. Okay, dropped by 35%, and now the S&P 500 has recovered and back to the original position, which is the 3,400 point and even beyond that. So from the bottom to the back to the original position, right, the gain is 60%. Okay, the gain is 60%. So you are actually looking at down 35%, and then you want to, in order to back to your original, you need to work extra hard. You need to work 60% gain in order to be back on your original position. So that means what? That means that it takes you a long or a much more effort to go back to your original position. So that means in your portfolio in the future, if let's say you are running a portfolio, you should have a certain amount of your portfolio in the fixed income fund, because you want to protect your overall portfolio. You do not want it to go into the negative territory. So you don't want it to go into a negative territory. That means about half of your position, right, has to be in a fixed income form, so that no matter what happened in the equity part, right, you have this fixed income return to cushion the negative effect. Okay, so this is important. You look at the situation. If you lost 25% of your portfolio, and then in order to get back, you need to get 23%. If you lost 50%, you need to get back by 100%. If you lose 75%, you need to get back. You need 400% of gain to get back to your original position. And if you lose 90%, you need 1,000 gain in order to get back to the original position. So it shows how difficult it is to recover from a debilitating loss. Okay, so that's why for a fund manager, right, the risk management is always part of their mind. It's always their top priority, because they cannot afford to make the portfolio to go negative. Okay, if it goes negative, right, it takes such a long effort, much more effort to restore back to the original equity value. So a lot of time, if let's say your portfolio is the objective of the portfolio is a conservative one, like our retirement fund, then you should have at least 50% into fixed income. And the fixed income can give you about 5 to 6%. It depends on what bond funds or fixed income that you are buying. The low low return one, the very, very safe one, maybe can give you 3%. And then some of the bond funds can give you 6%. And last year, it was a very good time for the bond market. So last year, the bond fund can give about 8 to 9% of a return. So it depends on the environment as well. So if you can have that kind of a position, a big chunk of your portfolio into fixed income fund, then at least your majority of your equity is protected. Your funds are being protected, and then the other part of it will be the equity, and the equity is due to the stock market volatility. So if you happen to have a big drawdown, right, so at least you have that cushion. Okay, so that's why when you look into building a portfolio, it's important that you have the right allocation of your asset classes. Okay, then next, how much what is your risk? Okay, so how are you going to measure this risk? How much money you are willing to lose per trade? So for a trader, their risk is usually 1 to 3% depending on your risk appetite. Okay, so that's a trader. So in a normal situation, if you are trading forex, usually it's a forex. They will look at it as 1 to 3% as your risk appetite. That means the amount of risk you are able to afford to lose. So how do you calculate? So for example, you are willing to risk 3% of your original capital, and your original capital is 20,000. Okay, so your 3% of that 20,000 will be 600. Okay, will be 600. So this brings us to the next question. What is your position sizing? After you know that your amount of the risk that you are willing to risk is 600, right? Then you need to use that information to work backwards. Okay, you need to use that information to work backwards and to calculate how many shares I can buy in order for that kind of a risk to lose. Okay, so a position sizing model simply tells you how much or how big of a position to take. Position sizing is the number of shares. So in short, position sizing is referring to the number of shares equal to the amount of risk over the stop loss. Okay, so for example, in this numerical example, we have Maybank. Maybank, let's say, is 750. And the amount of risk is, we calculated from just now, it was 3% of our 20,000, which is 600 ringgit, right? Then, and if let's say we look at the chart of that Maybank, okay, the chart of the Maybank, and then we see that okay, we see that this level here, it's 7 ringgit here. Okay, so let's say we purchase during this level here. Okay, we purchase during this level 750. Then we would we will see that, oh, there's a head and shoulder forming. Okay, it's a head and shoulder forming, and then that neckline is at the 7 ringgit. Okay, so the neckline is 7 ringgit. So if I bought at 750, right, so my risk here, my cut loss point here is actually at 7. Okay, my cut loss is at 7. So that means from 750 to 7, that means I need to lose 50 cents. If this thing happen, I need to lose 50 cents. So therefore my stop loss is 50 cents. Okay, so then you calculate your position sizing. That means how many number of shares you use. 600 divided by 50 cents, and then that will give you 1,200 shares. So that means for this trade, right, you need to buy 1,200 at 750 of the Maybank. Okay, you need to buy that. So that will be 750 times 1,200 share will be 9,000 ringgit. So that will be your 9,000 ringgit, and then you are prepared to lose 600 ringgit. You are prepared to lose. Does this make sense? Anybody who is unclear, I will explain again. You need to absorb it, okay? This is something that we never have done before, okay? We never really look at the investment in this manner. So this is how we calculate in terms of the position sizing, okay? Based on the amount of money that we are going to, the stop loss lah. So that is what I say. If you are buy and hold, if you want to buy the Maybank and then you don't want to cut loss, right? Does this matter to you? Okay, if you just want to buy the Maybank and then you are not willing to cut loss, and maybe you say, oh, when it goes down, right, I buy some more. If that is your strategy, right? So do you still need to calculate this position sizing? Actually, no need. This is only for when people are doing the stop loss. They need to calculate the position sizing. Okay, if you are buying and hold, you no need to do this.
This one strategy is suitable for futures, is it?
For futures, yes. Futures and forex, and all the speculative, or even the penny stock, or even the glove stock. If let's say you want to go for short-term trade, for those the technology stock or glove stock, you want to go for short-term trade, you can apply this one. So that means when it touches your stop loss, you have to really execute it, and then you lose this amount of money. That means this amount of money is the money that you are willing to lose. So then you cannot buy the share more than 1,200 share for this particular stock.